Forex trading is how individuals, banks, and businesses convert one currency into another. Trillions of dollars of Forex transactions take place every day, making it the largest financial market in the world. Unlike stocks and commodities, there's no central exchange for trading Forex. Instead, currencies are traded via a global network of banks, dealers, and brokers, meaning retail traders can trade Forex day or night, Monday to Friday. So how does it work? Forex prices are quoted in pairs because, in effect, you're simultaneously selling one currency while buying another. Let's take euro-dollar as an example. On the left is the euro, known as the base currency. On the right, the dollar, or the quote. If the price of euro-dollar is 1.38, that means 1 euro is worth $1.38. You'd buy this pair if you thought the base currency would strengthen against the quote currency, known as going long. Alternatively, you'd sell if you thought the base currency would weaken against the quote currency, known as going short. When trading Forex, you're always quoted two prices, the buy and the sell. The difference between the two is called the spread. Forex prices are affected by a range of different factors. These include interest rates, inflation, government policy, employment figures, and demand for imports and exports. And because of the sheer volume of traders and the amount of money exchanged, price movements can happen very quickly, which makes Forex not just the largest market in the world, but also one of the most volatile.